markets today. Seems like we are in for a decent start. Why so? Because just yesterday we have seen a good recovery coming in for the benchmark indices, and especially the Nifty 50 saw a good rebound. It was almost a flat day end for us, but Nifty Bank was lagging a little behind in the trading session. If we talk about some of the other sectors, then definitely today, all eyes will be on the IT space as bellwether TCS will be coming out with its earnings. But firstly, let's talk about the global cues. How did it pan out and what are the cues we are getting at the start of the day? Firstly, onto the Fed data, then FOMC minutes were out that hinted at moderating the pace of the rate cuts. The US private employment falls short of the forecast, and US futures were seen to be dipping as Fed signals caution about the dollar that was seen to be holding the gains but easing from the intraday's highs. But if we talk about the Nasdaq too, then there was a bit of a volatility there. But let's understand how was the global setup looking like. The US crude oil stocks was also seen to be falling for the 7th straight week, and we have seen the crude oil easing off from the 3 months high as well. But Nikunj, firstly wanted to understand what are the cues we are getting and how do you see the global setup as of now?
You know, it's like status quo, nothing new, nothing big, nothing incremental. It is pretty much an extension of what we've seen in the last couple of days, which is that the strength in the dollar is evident. Yields are stubbornly strong. Everybody is waiting for this entire dollar strength, in a sense, to reach its point of climax. Lot of narrative, yes and no, has started before the US President-elect Donald Trump takes over. And in general, the emerging market outflow, I think, is only intensifying. So you cannot say the global setup is conducive. You cannot use the word shaky, but the necessary conditions which are important for emerging markets to go higher or for outflows to stem, they are not getting created. We still have to acknowledge the fact that US tech stocks, barring one odd day, they are in an outperforming groove. Dollar, barring little bit here or there, the course of direction for dollar is strong. Fed has said nothing new, and the fact that FIs are selling, that really could be an interplay of what is happening to other emerging markets. So globally, you will have to say there is nothing new, there is nothing incremental, but there is nothing positive also, which in a sense could warrant any kind of a reversal in flavor of back for India. So FIs have been selling, and there is reason to believe that they will continue to sell.
Continue to sell. In fact, the dollar index heading towards that 109 mark this morning. Of course, a couple of important things from the global perspective that you need to watch out for is, of course, the Fed commentary. All signs are pointing to the fact that they're charting a slower than anticipated path of rate cut. That caused a bit of a nervousness when it comes to the markets throughout the world. And of course, the China data, which was out this morning in terms of the CPI, which is stoking the deflation fear. So that also remains negative, and that's the reason you have the global markets a bit iffy. If you look at the Nikkei right now, that's down 0.8%. Hang Seng is holding on, but Shanghai for now is down about 0.5%. And for now, the GIFT Nifty suggesting we are going to have another top pull at our hand when we start the trading session. That after the kind of a big volatility that we saw yesterday in the trading session. But yesterday we did manage to recover from lows, and that was the big highlight that we're talking about. 150 points off the lowest point of the trading session, which meant that the markets ended pretty much flat. A stark underperformance per se from not only the banking index but the broader markets, because the mid cap and the small cap indices were down over 1% in the trading session. Even if you look at the FI and the DI figures, it's not a massive sell figure coming in. Yes, there's a sell figure coming in from FIs yet again. And if you look at their positioning when it comes to the derivatives market, that does suggest a bit of a unwinding of sorts. But Nikunj, it clearly feels like it's the retail participation which is missing. A bit of a fear coming in, capitulation, the initial signs of that, because it's the broader end of the market which is under pressure, and the FI figures are not that big a sell.
Anisha, you know, there's always a trend and momentum. The trend is not evident and the momentum is weak. And when I say the trend is not evident, I'm purely speaking the Nifty language here. Frankly, we may talk about a poor Monday and a decent Tuesday and a comeback Wednesday. The bottom line here is that, let's go back please. The bottom line here is that for me, this is the data which will just come up on your screen. that just tells you that what markets have done in the month of Jan, and we are looking at now a complete comeback. I mean, markets have normalized, holidays over. We've seen Nifty move in a 700 point range. So there is nothing material which has happened purely in terms of Nifty giving you a cue. Bank Nifty, which was supposed to make a comeback courtesy FI selling, I think is not going anywhere. So the market is very simple. At higher level there is supply, at lower level there is demand. Something has to change either on the global market or in the local market for markets to really either break out of the range or go below the range. The chances of a breakout looks limited considering the dollar setup and considering the FI flows. The chances of a breakdown, I think, are higher considering where the mood is, what commitment is coming from the HNI brigade, and what kind of earning assumptions we have for at least the quarter gone by. So whether the bank Nifty will lead the Nifty down or Nifty will fall largely because of short selling, I don't know. But so far, purely looking at the market from the prism of Nifty is not been a very gratifying experience. Then you look at some of the rank mid-cap stocks, and that's where I think the pain has genuinely started. So there are 2 or 3 categories of stocks here. One are stocks which are patronized by retail folks. You know, Vodafone, Yes Bank, Suzlon, JP, they have already seen a big shave off. Then you have the rank mid-cap stocks where mutual funds, PMS schemes, they've also started correcting. So you've seen correction which has kicked in solar, correction which has kicked in some of the clean energy names, correction which has kicked in some of the utility names, correction which has kicked in, let's say, in some of the, Kalyan Jeweler, again, HNI dominated stock, it has kicked in. So that category also has started seeing a sell-off. So Nifty, if you look at the market and judge, okay, this is the Nifty level, that is the Nifty level, you will not make a market view. For me, I think something has to change for markets to go higher, which I don't see on the horizon. But with each passing day, the commitment level in the market seems to be drying up largely because of what is happening on the HNI front. What is the out of jail card? Which is the most important thing. हम यहाँ से निकलेंगे कैसे? What is out of jail card? So either the welcome back Trump rally has to peak out or pre-budget rally has to start. And we've not seen evidence of that either.
All right, that's the take coming in on the Indian markets. But today, all eyes will be on TCS as well, as the bellwether will be coming out with its earnings today. And this time, we are expecting a flattish growth when it comes to the US dollar revenue. The constant currency growth is expected just at 0.2%. The moderation in the BSNL contribution is expected to weigh heavy, as well as in the terms of the profit figure. Sequentially, almost a 5% jump is what we are expecting. But Nikunj, IT has been such a sector where in the past 2 quarters or so, we have seen a lot of investor interest coming in. Yes, all the investors were keenly watching out for some of the commentary related to maybe the AI boom, how they are looking forward to that, and even the valuations were a little comforting. But at this point in time, where we are looking out for the commentary, the IT sector is in for a bit of a moderation. What is your expectation from TCS, and what will be the key commentary to watch out for?
See, I've been bearish and I've been wrong. I mean, I never expected TCS or Infosys even to outperform considering the kind of growth what they've exhibited. For me, TCS falls into a bracket where successively they've underperformed and they've not really lived up to what the general expectations were. If I look at TCS earnings versus consensus, they have not really managed to beat the consensus 7 out of 10 times. And that, I think, is something which is critical for me. Also, I don't think TCS numbers would be an indication of what lies ahead for the IT sector, because you are seeing divergence within IT. HCL Tech will have a different view versus what we've heard from Infosys versus what we're likely to see from TCS. At 4,000 rupees, I think TCS will have to do something really special for the stock to go higher. But if they come out and give a very thanda commentary as to, okay, we are not very clear about where things are, too early to give some kind of a commitment, we are not so sure as to, hiring would move, I don't think it will warrant a lot of upgrade. For me, IT is going up largely because of the dollar-rupee interplay, not so much so because of a fundamental shift in terms of where the landscape is moving. While TCS has demonstrated excellence in terms of superior growth, superior margins, but they're also commanding superior P multiple. So I don't think that this earnings season from an TCS standpoint is going to be a swing event either which way, because they will, I mean, it's a conservative management, so they will not come out and say something very loud. And the growth is coming back, so they will not sound very bearish also. So you would just hang in there. That is my view. The stock is down 7%. If there's a little bit of push on that large base, how much can they do? Little bit here, little bit there, so 2% higher. If they do not give anything great, 2% lower. So I don't think a magnified or amplified reaction tomorrow. But again, disclosure here, 1.5 years, I've been bearish on IT and I've been completely wrong. So that's my view.
No, but I would concur there because there is nothing expected which could be a big blockbuster of sorts or completely move the needle. Q3 is seasonally weak in any case. Furloughs are there. The company was suffering with client-specific issues in the quarter gone by with respect to healthcare sector. BSNL deal is expected to ramp down. So nothing that can materially be very different from what the projections are. Let's see what the company delivers today. But of course, the other thing to watch out for, Nikunj, is of course the commentary that we're getting this morning from a lot of these brokerages. I mean, HSBC has gone ahead and downgraded India to a neutral from an overweight earlier. The Sensex 2025 target is now 85,990, and they're clearly just blaming it on the earnings growth slowing down. They're talking about how FY25 earnings growth for Nifty 50 has been cut from 15% to 5%. So that's the HSBC view on one hand, downgrading India to neutral now. While on the other hand, you have Macquarie, which maintains an overweight stance, and they call India the best secular EM story. Nikunj, do you think this is the case of, again, the brokerages being behind the curve? I mean, we have seen quite a bit of correction. We are in correction territory, down about 10%, and then now downgrading India. Does that mean we should assume a further downside, or they're just late as usual?
No, I think they're late as usual, Anisha. Why? Because now you got to ask yourself, is that what is in store for next 2 or 3 quarters? Are we likely to get hit with this earnings downgrade further, or is there a case for the earnings cycle to pick up? Now, for earnings cycle to pick up, you need government spending to come back, and you need interest rates to come back. You need interest rates to come down, and you also need to see a marked improvement in terms of whether consumption patterns are moving. I certainly expect sooner than later government spending will come back. Now, it's debatable whether the effect would be visible in this quarter or the effect would be visible in the next quarter. Large cycles like real estate, they are still doing okay. There is clearly no disturbing evidence which is coming, at least on the urban consumption front per se. So if earning is a combination of which way the government spending would move, which way the inflation, the rate dynamics would move, how credit growth in the system is moving, I think we are nearing the end of the pain, and I expect that by end of this quarter would be a bad quarter, then I expect incrementally things to pick up as the base effect would kick in. So to make a case that India should be an overweight now, I don't think it's a very justified case. Yes, you can argue about the technical selling which is happening in emerging markets and which could push Indian markets down. That's a fair call. See, Anisha, the general return expectations for this year are about 7 to 8%. And the most conservative estimate for earning is about 6 to 7%. So your return expectations by brokerages for this year is in line with earning expectations. So nobody is expecting anything very substantial in terms of a Nifty return now. Now you were expensive, but suddenly you have to now understand, Anisha, what will change is that from calendar 24, you move to 25. So you will suddenly start talking about FY26. You will suddenly start talking about FY27. That's not like a distance away. Like till December, FY25 was 1 year forward. FY26 was 2 years forward. FY27 was 3 years forward. Now FY25 calendar, the minute the year changes, your assumption for earnings also change. Because you will call the coming year as current year. So in that context, at 21 times with 6, 7, with 10, 12% kind of an earning growth, if you look at a combination of stock, it's not bad.
If you like this video, then like, share and subscribe to ET Now.